I'm so excited to talk about your paper, When Siri Becomes a Deposit Broker. And we've talked before about some of your research, and I'm really excited to think about how this emerging technology meets financial product design, meets financial risk, and then how banks can be conceptualizing and really like practice a lot of curiosity around the confluence or the meeting of these things.
Sounds good.
So tell me about your research in general and how you became interested in the question about AI, agentic AI plus liquidity.
Yeah. So as your listeners might know, I'm a professor. I study banking and financial regulation. And one of the hottest things right now in banking is AI. For the Roosevelt Institute last year or the year before, I wrote a pretty broad paper about just how AI agents can pose risk to the financial system in various ways. And this paper that we're talking about, When Siri Becomes a Deposit Broker, is really just narrowing in on one particular potential use case that I think poses real risks to the banking system. And it's one that I haven't really heard people talk much about. And so I appreciate the opportunity here to bring awareness to the risks of agentic AI deposit brokers.
Yeah, and I think about how technology, especially in the fintech space, is often spoken about from the kind of consumer benefits. And we don't often think about like maybe how banks need to respond to it, or when we do, we think about how banks can adopt this same technology so that it matches consumer expectations. But we don't. I think it is really useful, especially now when we think about AI, is like, how did the internet change banks, right? Or people will bring up how ATMs changed bank liquidity because it changed operating hours, technically. And I think these are really good moments to kind of check in and be like, okay, well, if it can do all of these things, kind of what does that mean for a bank? Do you use agentic AI to manage anything like your deposits or money? Like, do you have any experience with these products?
So I don't. And to be clear, I don't know if there is anything actually commercially available that'll do what I'm talking about here. This really is a thought experiment. The technology all exists. It's just I haven't seen anyone put the tools together in a way to make AI agents interacting with finance a thing. I imagine we're there. I think there's money in it. I just haven't seen any products yet. Taking a step back, kind of what we're talking about here.
Yeah. Let's talk about the thing you're talking about.
Yeah. So imagine you have a phone, and Siri is now an AI agent. You can ask Siri questions. You can tell Siri to do things on your phone. The question is, what happens when you tell Siri to manage your bank account for you, to manage your money for you? I think there are some real positives that could come of this. You could ask Siri, what stocks should I invest in, or what type of stock should I invest in for my particular risk profile. And if it gives you a correct answer, I think it could be a positive thing. What I'm talking about here is what happens when you tell Siri, I want you to manage my bank account to minimize losses or to maximize yield. And Siri could, going forward, migrate your deposits from one bank to another based on what institution has the highest yield at any given day. It could take in information from the public about if a bank is experiencing a run or something like that, and move your money out. We think a lot about Silicon Valley Bank and what happened there. It really seemed to be a network of people, all relatively connected, that withdrew their funds at the same time. Well, what happens if Siri hears that there's a run on XYZ Bank and pulls everyone's money out of it without anyone actually taking any affirmative action to start that happening. That's kind of the fear here.
So that sounds like the central question of your paper, right? Is
Yes.
This thought experiment is, what if this technology exists and was widely used? And what would be kind of some of the implications, not necessarily for the consumer, although it sounds like you've just mentioned some, but what would be the implications for the bank, or how should the bank be prepared for this technological reality? Is that fair?
Yeah, that's totally fair. And yeah, I'm looking at this really from the bank's perspective. I think it's really hard. My understanding of the way these open banking APIs work is that the bank really doesn't have a lot of information about how the data is used. All they see are the different calls that your third-party app is sending. So they might not know that you're using Siri or another AI agent to manage your account. All they should know, or all they can know right now, is that the deposits of people who use this kind of service suddenly become hot money.
Yeah.
I talk about deposit brokers. Deposit brokers are institutions that will move money between banks for customers.
Yep.
Sometimes on behalf of the banks themselves, moving it around for to maximize deposit offerings. Sometimes for other purposes, and basically these AI agents can feasibly do the same thing.
Why is the deposit broker designation important for banks? Like, how do banks conceptualize a deposit broker versus a bank customer if the broker is like acting on the behalf of the customer?
Yeah. So the FDIC sees broker deposits as hot money, and they created a study way back in, I think, 2011.
I know, I love this study.
Where they evaluated, it's called Study on Core Deposits and Brokered Deposits. And basically what they concluded is that having a high volume of brokered deposits can impose additional risk on a bank, such that when the bank fails, a bank with a higher percentage of broker deposits is more likely to fail than one that's not. It's because it's hot money. It's because they have to pay more money to get those deposits. And because you have a professional money manager managing it, it's more likely to be pulled at a moment's notice. And so the FDIC expressed concern about banks relying on broker deposits to fund their loans, finding that banks can face mass withdrawals, basically.
Yeah. So before we kind of move further into the thought experiment, another term we want to talk about is the term agent, and then AI agent, because those are actually like probably two different things from a legal perspective or a financial perspective. So could you define both of those terms for us?
Yeah. So in the law, an agent is a person who acts on behalf of another person. They have a fiduciary duty to that other person, and they must act in that person's best interest. Okay, that's agent. AI agent is a new term of art that I think is created by the AI companies that basically is software that you tell it to do something and it'll do it for you. You can mess around with ChatGPT. It's got Agentic software where it'll unsubscribe from emails for you and will make purchases on Amazon for you and all sorts of crazy stuff like that. They call it AI agents. The thing is that they don't provide this fiduciary duty, basically. They are just providing some kind of service, and they disclaim that they have any fiduciary responsibility and have to act in the customer's best interest.
Yeah.
So really quick. So when you think about AI agents, I think most people would think it's doing the thing I want it to do. It's doing it for me, and it has to do it in the way that helps me. But that's not necessarily the case.
Yeah.
Yeah, it's really concerning. And, away from this whole deposit broker thing, like, I think this is one issue that the AI ecosystem is sleeping on. I think there's going to be huge legal liability for them from, I don't know, the FTC or the CFPB about claiming that these are agents, but not acting with that agent duty and responsibility.
Yeah. And I think especially when it comes to financial services and people's money, and the misconception, like what people have in their mind when they hear something or when they read the description of something and what that means as far as their legal protections. Yeah. These are like really important questions, especially for maybe not banks per se, because banks are kind of the recipient of this, but these are really important questions for regulators to think about when we think about consumer plus money, right?
Yeah.
Because, as Synapse has shown, people have ideas about when something is interacting on their behalf or putting money on their behalf at a bank, and they have ideas about what that means for their protections or rights, and maybe what the regulators see as their obligations or what the banks see as their legal obligations, right?
Yeah. And I gotta say, customers should not have to know about these things. Like, it should not be the customer's responsibility to dig into the
buyer beware. What?
I know. And I think Synapse is such a great example where the legal language they used made it a little bit ambiguous about what they were doing, and like no one should expect end users to understand the difference between different types of accounts.
The conversation about depositor discipline on banks is one for a different podcast. But back to your paper. So one of the things that I was interested to think a little bit about the urgency of your paper and the why this, why now, especially because some of the activities that you describe could exist without AI agents, right? It's just it's just automative technology and APIs, right? The infrastructure is already in place. In what way does AI make this more urgent or a bigger concern than what we currently have or what we maybe had 5 years ago?
Yeah. So scripts will do basically anything that AI agents will do. I'm not really positing anything that is brand new or could not have been done before.
Yeah.
The difference between AI and a couple of years ago is that it makes it so easy for anyone to set up a system that will do tasks for them. So in the paper, I talk about text to code or speech to code large language models, where you tell the model, I want you to develop code to do something, and the model will create code to do it. And so what we can imagine is banks' customers telling Siri or whatever AI, like, I want you to create code that will interface with Plaid's APIs to do X, Y, and Z. We call it vibe coding. You can just vibe code these types of technologies, and it's feasible that you could make Siri do this kind of thing without anyone else coming up with the idea or anyone offering that kind of product. And it's opening up a whole new world about what is possible and the risks. We're talking here about risks to banks, and that's what the paper is about. I also want to flag that I think there's also risk to the AI agent, the creators of AI.
Oh, don't worry about those guys. They're fine.
I'll take it back.
OpenAI, they don't, come on. Yeah, they're threatening humanity. They don't need to worry about financial liability because their ChatGPT didn't legally agent on someone's behalf, right?
Yes. I hear you.
Okay, so your paper flagged concentration as a risk, but not in a too big to fail way. Why does having a few models that would be vibe coded for the deposit brokering pose a risk to banks? And do you think we need more LLMs? I've never heard more LLMs would solve this problem. So is that what you're proposing?
Kind of, yes. Okay, so there is a problem people are coming up with, or people have identified, that if everyone is using the same LLM to interpret data, the AI agents are all going to react the same way when they all see the same data. So you can imagine one model seeing a data feed come in of, information about a bank, and it interpreting this data and saying, yes, this is totally fine, no problem. You could have another model that sees the same information and says, whoa, red alert, it's time to move money out. And so if, 25% of a bank's customers are using software that relies on that second LLM, you're going to see a huge outflow, even though other LLMs thought everything was safe. And so the solution does seem to be to have many different types of large language models out there with software that can rely on different ones. I mean, it's basically AI antitrust.
Yeah.
For banking, but also for, every other tool or area where this kind of stuff is used.
It's kind of like a groupthink thing, right? Like the issue is that the models, they're just not diverse enough from each other, and they're not going to produce different results. And but at a certain point, maybe they're all producing the same result because that's the correct result. But the way they're interpreting signals, right? Especially in markets, right? It's sometimes useful to be countering what the crowd is doing.
Yeah. Absolutely.
Although I don't know about for bank failures if that's really useful. Maybe you move all of your broker deposits into the failing banks. I don't know.
I would. Oh, that's
because they're insured. Sorry, that's a joke.
Yeah, we should just skip that.
Okay.
No.
Fair.
But I think you're absolutely right. It's concentration risk.
Yeah.
And it's something that is concerning. If a quarter of a bank's customers are all using the same LLM, and it's going to tell that quarter of depositors to pull money, that's a problem. Maybe it is the right answer, but maybe it's hallucinating, getting some kind of wrong response, and it results in herding behavior, HERDING behavior of the customers.
Well, and the other thing too is you mentioned these AI models would either yield maximize or they would run for safety. And I think one of the things that's really interesting is if I, when I read your paper, I imagined me using it, not necessarily a company using it. So why would I need an AI model to move my money for safety and soundness reasons if my money is insured? And so I think there's actually an element where the AI in doing its executing its job that I gave to leave a failing bank is actually kind of making it worse because I don't need to leave the failing bank and my deposits would be stabilizing, right? And that's what we kind of know about retail deposits is they can be very stabilizing to the money that does move, right? Yeah. That not all the money profit maximizes, and also not all the money is responsive or needs to be responsive in a failing bank situation. We can talk about whether or not that's good, but my money just doesn't need to move, right?
Yeah. So I think there are kind of two categories of depositors we're talking about here. One is consumers, retail consumers, you and me. I do not have $250,000 in my bank account. And so, no, I don't need to worry about that. But we can also talk about companies that have transaction accounts. Companies... medium and larger size companies have treasurers who engage in treasury management. And so if it's someone's job to ensure that you have adequate liquidity while you are also getting enough yield on the assets, you could absolutely see a treasurer getting some kind of software that will just do this for them. And they certainly will have money above the $250,000 threshold. And it's those those types of entities that were the ones that caused the run on SVB. It was small businesses, medium-sized businesses, who all at once decided to pull all of their funds.
My colleague Alex Johnson has written about how open banking might make all deposits hot. And I think SVB, one takeaway from SVB that I don't know has been, hopefully banks shored up liquidity, but it just kind of showed that a lot of money can get hot very quickly, and that this money was maybe not hot 24 hours ago, that money can really reach a boiling point and leave, and it can leave very quickly. And banks may not be attuned to that. And one thing I think is always useful about time deposits is at least that is predictable to a certain extent. Yeah. And I've been told, and I'm not a big brokered CD customer, but brokered CDs very specifically have sometimes pretty hard terms to withdraw early. And so that's maybe, it's hot when the time is up, but it's not hot until that. But you're flagging that AI agents could make more money hot more quickly. And one of, I think, the concerns is that a bank doesn't know that its money is hot and that it doesn't know that the money could leave. Do you have any research about institutions that didn't classify brokered deposits or other types of deposits as correctly and then suffered adverse consequences from misunderstanding the nature of those funds?
Yeah, I mean, I don't really know outside of Silicon Valley Bank. No, we did not think of their deposits as being hot money, but all of a sudden they were. And it's because there was some kind of interconnectedness that wasn't previously seen about the way those deposit networks operated. Right. It wasn't, these deposits weren't classified as brokered. I don't think anyone would have, even looking back, have classified them as brokered. But at the end of the day, it turns out that they were moving as a network because of just the interconnections of the different depositors.
Yeah, we've talked about Synapse once already, but one of the things that's really interesting about the middleware, the fintechs, the banking as a service banks, is the nature of the money that comes in through those relationships, and how easy it is. The question for me is how easy is it for any single person to significantly move those deposits? And we see sometimes the middlewares move, and we've seen sometimes the programs move. And I think those are really the contracts are very important to making sure that money isn't hot. But if one company can move a giant FBO account, and it can, and that would certainly take a lot of time, but that's probably a lot of money that's leaving that wasn't seen as hot. And the question for me is and it's not, and right now, that's not brokered money either. And the question for me is would a bank want to interpret the agent here as being able to move the money as maybe it's not fully brokered, but it's not cold money, or it's cold until contractually it could be pulled as part of the negotiations we have to do. You know what I mean? So these kind of how to think about this funding.
Yeah, I do. And I think that's a very good point, that when you have these fintechs with massive FBO accounts, they are not considered brokered under the FDIC's regulations. There are reasons for that. That's probably another.
It's a whole other podcast.
but yeah, it is potentially hot money, or at least hotter money than if those were individual customers. And I think that when people have deposits that are brokered by these AI agents, they definitely should consider them as hotter than traditional deposits. And should either keep higher liquidity just in case they move, or consider them time deposits and place restrictions on them. I don't know if I'm going to preempt you, but in the emails before this, you talked about the difference between now accounts and demand deposit accounts.
Did you have to look that up? Are you so excited to bring this back?
I did not have to look this up. I know what now accounts are. I was not alive when there were now accounts, but I know what they are.
Well, okay. Do you know? Okay, let's talk about this now. I've got a bunch of questions, but let's talk about one of my ideas for you was bring now accounts back. And I had to learn about now accounts because of industrial loan company charters. So ILCs can only offer now accounts. They can't offer a type of account called demand deposit account, or a DDA. A now account, and I know this is a bad acronym because a now account is a negotiable withdrawal account, order of withdrawal. And in the past, that meant that like you couldn't pull all of your money out at once, or you didn't have you could only do it if the person that gave you the account allowed you to do it. Yes?
Yes-ish. It tended to be you could withdraw your money, but it was subject to a 7-day hold by the bank.
Sure. Okay.
And so it's your money, you can get it out, just maybe not on the time frame that you are hoping for,
right.
Because it better enables banks to manage their cash flows. Anyway, keep going.
No. So my proposal for you is, should banks change some of their accounts that are DDAs into nows and enforce that 7-day withdrawal over maybe if the withdrawal is over 50% or something, enforce that as part of a way to manage some of their liquidity risks that come out of these AI agents?
So that's a very good question. And in the abstract, I have to say yes.
Okay,
but
good.
I also know that there are pretty significant regulatory implications from now accounts versus DDA accounts.
Okay.
And so you actually just talked about one. The reason that ILCs offer now accounts instead of DDAs is because if they offer DDAs, they'd be subject to the Bank Holding Company Act.
Okay.
And it's that 7-day or whatever pause that says that these are not demand accounts, and therefore they aren't subject to the BHCA.
Sure. I mean, like, yeah, every time I learn about stuff, I'm like, that's fake. We can change that. Like,
you would hope, but it hasn't been changed recently. It's been like 40 years.
So, okay, outside of my proposal to change DDAs to nows, and give banks some time, legally give them time. Yeah. What are some other liquidity management thoughts you have around the question, or advice that you have around the question that you were exploring in this paper?
Yeah. So I think banks need to be aware of who is using APIs to manage their accounts. Given
I am.
Yes?
I'm using them.
Yeah,
well, I'm using it for like YNAB, not for like Venmo. You know what I mean?
But I mean, Venmo's a different. Venmo's another podcast. But
sure.
You know, I mean, like, I think that banks need to be aware of who is using APIs to manage their accounts and pay special attention to them, because they have the potential to be hotter than your standard issue accounts, or accounts that aren't using APIs. APIs just are really changing the game. I think that banks also need to be in contact with the API providers to give them more information about how the user is using the APIs. As I said, you know, I've talked to folks at some of these open banking firms, and my understanding is that banks don't know what application is using the APIs to manage cash flows or whatever. And so the banks really need to have some kind of insight into that to see if it's Siri that's using the API calls versus, I don't know, I have a what's the word I'm looking for? Just like a budgeting app that is not going to provide, or it's not going to pose this risk to banks.
Yeah. And it is one of my questions that your paper kind of touches on was that, and relates to the SVB, was that, do banks get enough information, and do they get it fast enough about deposit withdrawals, period? Like, how fast would you get information that you are having a deposit run? Is it immediate? Is it 1 hour? Is it end of day? Is it when the bank closes for the day and we tally up withdrawals and deposits? And, your paper can't touch that issue because that's not the central point. But that, I think, is a question that is still pretty open from SVB. And I do think we saw more banks shore up liquidity, like shore up backup liquidity, and are able to connect to the discount window. But the discount window is not a 24-hour thing. It's not fully online. And so there is a timeliness element of like, are you even just getting this information fast enough that you can track it in real time that this is happening?
Yeah, I think the answer is no. My understanding with these, my understanding with these APIs is that most of the calls are done. There are calls direct to the banks, but actual transactions are done over ACH just because of how cheap it is. So you've got the inflows and outflows that are tallied. I think ACH is just end of day. And so end of day
I'm like not the person asking about this. I think it's batched. I think it's a batched thing.
I think it's batched. It's either once a day or twice a day.
I think it's twice a day.
Okay. But you're getting these batches not in real time with some kind of lag. Mm-hmm. And that that makes it more difficult to see what's happening. As an aside, I think banks really need to be worried about the rise of real-time payments, because real-time payments give you all of this information in real time, but banks also need to send the money in real time. And that's going to pose serious liquidity problems if banks aren't careful. It makes money several hours hotter, which doesn't sound like a lot, but I think in big enough quantities, it definitely could be.
Yeah. So the other thing we haven't really talked about was the role that regulators play. So you cited the FDIC's study on core deposits, which I don't think they've ever updated, sadly. But, this would be a problem ultimately for the insurance fund, right? Or this would be a problem for regulators of how should we be assessing the liquidity of these banks. Do you have any thoughts about what's possible from a regulatory perspective, or how regulators can be beneficial and proactive here?
Yeah. So one thing to know is that the FDIC regulates banks. It does not regulate deposit brokers. So folks like IntraFi are not regulated.
Not a deposit broker, are they? They're reciprocals. So, and reciprocals are not classified as. I know this is the definition of deposit brokers. We have not even I could have gone so far on that train. But yes, they don't regulate IntraFi. Yeah.
So they don't regulate the people who move money around on behalf of other people. They regulate banks, and so. The way that the FDIC has done this so far is to, and this is in the statute, is to regulate who is able to accept broker deposits and in what amounts to limit it. We talked about why some of these fintechs, their deposits aren't brokered. It's because if they were, it would be subject to all of these statutory restrictions. So the FDIC can't regulate deposit brokers. It can't regulate anyone but banks. And we already talked about how banks don't have a very good picture into what is happening. So the FDIC definitely doesn't have a good picture. I propose that Congress give the FDIC authority to regulate deposit brokers and other similar institutions. In order to just make sure that this type of run can't happen. We don't want to give the FDIC authority to regulate Apple, but to the extent that Siri is acting like a deposit broker, or any of these other AI agent software, I think the FDIC should be able to step in.
The other thing too is the FDIC. So the FDIC, a deposit broker exists in part because it is defined by statute from Congress, and so the FDIC is always it can't get rid of the classification or designation, but it can probably define. It could write a definition that potentially includes AI agents that are acting on the behalf of a customer. And that's maybe in the same way that the FDIC defined that the fintechs are no longer deposit brokers, right? And so there is maybe a way, without necessarily the FDIC regulating deposit brokers, there is maybe a way to expand and bring these agents under the umbrella when they are doing certain tasks, right?
Well, so the FDI Act, I actually don't know if it defines the term deposit broker. It defines the term broker deposits.
Oh, that's right.
And allows the FDIC to modify that term a bit. But again, the FDIC can only regulate banks. It can't regulate deposit brokers.
Right.
So I guess you could say that it's going to define these new deposit accounts as broker deposits, but that opens up a huge can of worms about which institutions can receive them.
Yeah.
A bank has to be, I think it's well managed under its CAMELS rating, and that could shut out a number of banks from receiving just customer deposits.
Yeah.
That would be hugely problematic, I think.
I think I don't know if it's the FDI Act. Don't quiz me on this, but I think it does. I think the FDIC does have to have a definition of a deposit broker, because it's like whoever is engaged in the act of placing deposits. And it's why, oh my God, this is such a tangent. It's why newspapers aren't deposit brokers. And it's why they're listing service deposits. Todd, I'm going to blow your mind. Deposit brokers used to like call up banks on the phone and place deposits, but a bank could advertise its rates in a newspaper. And the question was whether the newspaper was a deposit broker, or was it just like more of like a community bulletin board where you could place information. And so there we have the definition of a deposit broker, someone who is actively involved in the placement or the facilitation of deposits, and the creation of the term listing service.
Okay.
They can be the same deposit. I'm not kidding. They can be the exact same product, same rate, same terms. But if one comes from a deposit broker, it receives one classification. And if one comes through a listing service like Quick Rate, or there's like some others like there, and it's like I know it's what I actually think is really interesting though is I'm talking about something that was like these things mattered in the 80s.
Yeah.
It was a framework. These were rules. These were definitions we created for the technology that was at the time in the 80s, which were telephones and newspapers, I guess.
Yep.
And then today we are talking about agentic AI. And where does agentic AI fall into our understanding of a thing that does something on the behalf of a consumer? Right. And does everyone like agree on this definition in the way that like we kind of agree about Quick Rate sometimes being a listing service? You know what I mean? Like, yeah. And we're actually kind of not having that conversation in a lot of ways. We're really not. And when we don't talk about this technology and how people can use it and banks are kind of scared of AI, right? They're kind of worried about using AI, but they're not, and they think about fraudsters using AI against them. But what they don't think about necessarily is, hey, there might be financial tools that are marketed to customers' benefit, and I don't necessarily have an opposition to my customer using this tool if it helps them with their personal financial goals, but I might have negative consequences that I need to manage for if my rate isn't competitive or if if the customer's money isn't locked up, right?
Yeah. Yeah. No, that's exactly it. Banks have been thinking about their own uses of AI. Banks have been thinking about malicious actors, but so far I haven't seen banks really talk about what happens when their customers are using AI for pretty innocuous purposes.
Yeah.
That is something else that needs to be on the radar. This is just one way I think it could happen. But, AI is changing so fast. It's evolving every 6 months. And so we really don't know what the future holds.
Right.
I think that when you or I use AI agents in this way, I think the CFPB has some kind of role it can play. But when it's a company's treasurer using it, there's no one And it really is just up to banks to figure out how they're going to deal with that.
Yeah. So many companies and industries have had to use short-term funding and translate it into their long-term spending. And banks are a little unusual in that that's both like true and not true at the same time. But from a paper versus deposits, right? Yeah. So how much of a concern is it if banks just have to now think about their money being hot or their duration or being, think about it from maybe a paper perspective or think more about the duration? Like what kind of consequences do you see short of massive runs and flights to safety? And
no, I think that banks, their net interest margin is going to get compressed if deposits are not stable, if they can, run or flow out at any time, you have to invest them in shorter duration investments. And that reduces net interest margin. In the paper, I look at which types of banks are more reliant on NIM than others, and it's community banks. The larger guys have all sorts of other sources of funding, other sources of income, of revenue. Yeah. But the community banks really don't. And so if net interest margin starts compressing, it's going to be community bankers that are going to really face the consequences of this.
Yeah. And I think about if we are in a decreasing interest rate environment and banks are looking to lower their cost of funds while and hoping that their customers don't notice, but at the same time, technology has made it so much easier to outsource this from their, the customer just uses the AI agent to do it. And that if they want to keep the funds, they may have to be more competitive on pricing, and many banks are resistant to using pricing to defend relationships, right? And so it's kind of, in some regards, I do think banks just need to be more mindful that they're that the high interest rate environment plus technology taught a lot of people how to yield maximize, and that is unlikely to revert, right? Where everyone just learned how to use a computer in COVID to open bank accounts and move their money around and find a high yield checking account, and we're not going backward.
Absolutely, and I'll also say one thing that I know a lot of bankers don't want to think about, but we now have stable coins to compete with. Todd,
we got through this whole podcast without you mentioning stable coins. How dare you?
I know. But really, so stablecoin issuers have found a way around the prohibition on offering yield, and maybe Congress will address it, but maybe not. And I'm now seeing that I can go on Coinbase and get USDC, and it'll pay rewards of more than what my bank is offering me.
Sure.
I really like the fact that my deposits are insured, but I think that there are people who just see a different number and go with the higher number regardless. And if AI is going to do it for you, you don't even really need to care. And I think that the assets that the stablecoin issuers are holding customer funds in are big companies or the government who are not going to be using community banks to hold their deposits.
Mm-hmm. So my final question for you, and we've talked a little bit about this, but what advice do you have for banks that are now maybe more attuned to this problem that you've identified for them?
Yeah, I would really try to figure out how many of my customers or what percentage of my deposits they're using open banking APIs. I think that is just a really useful piece of information for banks to have as the ecosystem evolves.
Well, Todd, thank you so much for talking with me today. It sounds like we've got a couple of other podcast ideas that came out of this episode. So I'm sure I'll have you back on soon.